Okay, perfect. We'll go ahead and get started then. So I guess I'll just stay seated. I'm just presenting here. Okay.
You can stand if you want. I think I'm planning on standing.
We
so
can stand?
I
Okay,
think I
I'll
can-
stand. Nobody?
I don't know if I can talk better or not, but it makes me feel better.
Maybe it'll make a difference for my presentation. Hi, everybody online. My name is Jill Otley, and I work here in the tax department at Squire. I'll go ahead and move to the next screen so I can kind of introduce us since you're not seeing us on camera, just the presentation. Let's see if it's gonna, there we go.
Yeah.
So that's me in the middle. So Doug McKay and I all work in the tax department here at Squire. And McKay also works in our wealth department. And we'll be presenting today on some tax planning strategies for individuals. We also have a meeting tomorrow for businesses if you're interested in attending that. There's a little bit of crossover, but today we're primarily focusing on things you can do as an individual, and tomorrow tax planning strategies, end of year things that you can do for your business. So we would invite you to attend that as well if you would like. Okay, so I'm going to get started. Of course, tax rates right now haven't changed for the last couple years. So we've got 12% or 10% rather is the lowest tax rate at this time, going up to 37%. And as of right now, the proposed legislation does not have an increase. At times it has been in that highest tax rate would go up, but right now it's not there. So for those who are in very high income earners, usually they'll plan on about 37% of their income going to federal tax. That's just federal tax there. So, but no matter what income you make, and I think this is a misunderstanding for some people. So say somebody makes 100,000, that first 9,950 that they make, this is a single person, would still be taxed at 10%. So it'd still fill that bucket. Then the next bucket up to the next level would be at the next rate up to 20 and then to 22% and on and on. So you still kind of fill those buckets. And so it's just everything over that higher amount of 523,600 for singles, or 628,300 for married filing joint. That would be at that at the highest percent of 37%. Oops. Standard deduction does go up a little bit every year. So for this year, we have about 12,500 if you're single or married filing separately. The standard deduction for head of household is 18,800, and married filing jointly is 25,100. And as probably a lot of you know, a lot more people are using the standard deduction since it is so much higher than it was prior to the Tax Cut and Jobs Act. The estate exclusion right now is at $11.7 million. That's per individual. So a married couple would have twice that. So that's the amount of their estate that would not be subject to estate tax upon their death if they were to die in 2021. That is scheduled to be reduced back down to probably around 5 or 6 million in 2026. And they have thrown around ideas of putting in the legislation to lower that sooner, but right now that's not in the current version. Itemized deduction. So for those who do itemize, there's a couple different strategies. Again, because the itemized deduction has been higher, fewer people are itemizing. But for those, and this applies to a lot of people who are charitably minded here in Utah, there's some different strategies that can really help maximize the tax benefit of your charitable giving. So some of those are bunching, or kind of the timing of your contributions, or making qualified charitable distributions I think Doug will touch on this later, or McKay will touch on it later rather. But there's ways to kind of use the advantage of not having to pay some capital gains when you're pulling money out of retirement plans by instead donating that to charity. There's a home mortgage interest deduction, and then up at the top, the state tax and property tax as an itemized deduction. The last couple of years with Tax Cut and Jobs Act, that's been capped at 10,000, the tax portion of the itemized deductions. But the current proposal is that would increase up to 80,000, which could really make a significant difference for those who pay a significant amount in state tax, which a lot of clients do. If you make a significant amount of income, Utah taxes 4.95%. So that can definitely make a difference. And there can be some things that you can do with that if this legislation goes through. So this would be next year in terms of making estimated payments or what you pay in that actual year to maximize your itemized deduction at the right time. And with all these things, I guess it goes without saying, if you have individual questions, we will have time for questions at the end of this presentation. But if you have additional questions, you're always welcome to reach out to any of us or to your advisor here at Squire and dig into these further and for personal application. So for other deductions that we want to cover. Sorry, I keep pushing the wrong button.
Could you stand on the other side, Tim, so we can see the screen?
Sure.
You know, if you want to sit.
Maybe I'll just sit.
Okay, thanks.
No problem, thank you. Okay, so some investment related tax planning strategies and other. So health savings accounts. This is something that comes up frequently with clients. We highly recommend maximizing the amount that you can contribute to a health savings plan. If you have a high deductible health insurance plan, usually that goes hand in hand with a health savings account. And that's a great way, anything you contribute to that will not be subject to tax. And if that money is later on used for medical purposes, it will never be subject to income tax. So almost an advantage there over a retirement plan where it's just deferred taxation. And usually most HSA plans, there's options to invest the money within the plan. So very similar features to retirement plans. Of course, there are retirement plan contributions. So I think it's 19,500 is the max that you can contribute to a 401k this year. There's so sale of home. A lot of people know this, but if you have lived in your home 2 of the last 5 years, when you sell it, you do not pay capital gains tax on that gain. So that's kind of, especially nowadays where home prices have gone up so much, that's a great opportunity to, cash in that investment and not have to pay capital gains tax on it. People if you wanted to really maximize that, you could buy a new home every 2 years and sell it and use that over and over again. Most people don't want to have to move that often, but it is nice to take advantage of if you're going to be selling your home anyway. Some people sell their home and then rent it for a couple years, but we usually will advise if they want to take advantage of that capital gain exclusion to sell it within, so they've only rented it for 3 years. So again, they've lived in it 2 of the last 5 years. They could still use that home sale exclusion on the gain, most of the gain, if they turned it into a rental. Opportunities to take capital losses if you have investments where you can kind of harvest those losses to offset gains. Student loan interest is a deduction, and then business use of your home or car. Keep pushing the wrong button, sorry about that. Okay, talking about individual tax credits, there's the child tax credit, which this last year, people have been receiving advance payments starting back in July. Those were kind of calculated based on your 2020 or 2019 filing. So the good news is that the child tax credit overall was increased for 2021, depending on the age of your child. So it's bigger overall, but due to advance payments, people receiving an advance portion of that, there'll actually be less on the table for most people come April. So more overall, but because of the advance payments, maybe a little bit less available come April. You can opt out of those payments. At this point, there's not really time to do so before the end of the year, but we have told a lot of our clients, you know, if they're worried about maybe having slightly higher tax come April, to just kind of hold on to those advance payments so that they're available to offset any tax owed in April. The recovery rebate credit. So this happened last year with the first and second economic impact payments. If there was any missed portion, that was included with your 2020 refund. The same will happen with the third economic impact payment for 2021. Child and dependent care credit. So if you pay for daycare for your children, there's a tax credit related to that, also an adoption credit. Residential energy efficient property credit. So if you have solar panels put on your home, there's a federal and state credit for that. This is a really popular one right now, the plug-in electric vehicle credit. So there's a number of electric vehicles that qualify, and it's quite a large credit. It's set a $7,500, you know, this is a tax credit, not a deduction, so the impact of this is quite large. Those who buy a qualifying electric vehicle, and you can look up that list online. The credit's available on so many vehicles of each manufacturer. So Tesla vehicles, for example, some of those they've already sold the max number that apply for the credit applies to, but there's a lot of vehicles out there where this is still available. Education credits. So this is something those with older dependents who may be attending college, we always let them know to have their student request a 1098-T, even if they think, oh, everything was paid with scholarship money, I can't get a credit. There are a couple options to reallocate the scholarship funds and still receive a tax advantage from those credits. So it does phase out around income levels of 150,000 plus, but always good to check on that again, whether or not scholarship monies are received.
Jill, there's a question.
Oh,
Do you
sure.
want to wait until the end? This is from a previous slide, but can we prepay some 2021 state taxes before the end of the year instead of in April 2022, then use that prepaid amount as a SALT deduction for my 2021 taxes?
Well, the 80,000, if it goes to the 80,000, would that apply to this year, do you think?
If you're under, I hope, but I would say if you're under the $10,000 state and local tax limit, absolutely do it. If you're going to itemize and you're under that limit, absolutely do that. So, which means you'd have to have enough charitable or interest deductions and things. Otherwise, you're betting that 80,000 would go through. I think the last I've heard, there was kind of negative news on that out of Washington, but we still don't know.
Yeah. The risk is that, the legislature doesn't pass that, and then, it's kind of a gamble at this point. Let's see. Okay, I think it's McKay.
Jill, do you mind if I sit there?
Yes, please do.
Here. Okay, so I'm going to talk about some tax planning strategies as they relate to different types of investments. Like Jill mentioned, I work for the in the tax department as well as the wealth management department. And so some of my favorite ways to get tax deductions is by contributing to retirement plans, because It's one of the only ways where you can get a deduction without spending money. You're just setting it aside for later use. And so traditional and Roth IRAs, most people are familiar with those. The limits for 2021 and 2022 are 6,000 if you're under 50, but the IRS allows you to contribute an extra $1,000 if you're over 50. And so how those work in a nutshell is with the traditional IRA, you get a tax deduction today when you file your tax return. But when you pull the cash out of the account during retirement, those funds are subject to tax at that point. The IRA is kind of the opposite. You contribute the cash today, but you don't get a tax deduction on that year's tax return. But during retirement, when you pull the funds out, it's not subject to tax at that point. And so everybody always wants to know if they should do traditional or Roth, and it's really hard to know exactly. But in general, the best way to go about it is if you think you are in a higher tax bracket today than you will be during retirement, it makes sense to do a traditional contribution because you'll be able to deduct that contribution at a higher tax rate than the income tax you'd have to pick up during retirement. And so that's one way to think about it. If you decide to go with the traditional and later change your mind, or you have a low income year, currently there are opportunities where you can convert your traditional IRA to a Roth IRA and pay the tax on the year that you do the conversion. But we'll talk a little bit later about how President Biden's Build Back Better plan might change, so I guess might present some additional issues in that strategy. 401k plans, a lot of employers provide 401k plans for employees. 2019 limit is 19,500, but for 2022 that jumps up to 20,500. And if you're over 50, the IRS lets you do a catch-up contribution of $6,500. And that catch-up amount is the same for 2021 and 2022. So that's a great option to defer a lot of tax. And you also have those same contribution methods in most plans to do traditional or Roth. And typically once you retire, you'll roll over your balance into an IRA, just so you have more control over it. Self-employed individuals can set up a SEP IRA or a solo 401k and are able to get a decent chunk of money into those accounts. The maximum amount you can get for 2019 is $58,000. And that's broken up between your $19,500 employee deferral, the company match, and any profit sharing. And so the maximum compensation limit is $290,000. So moving on to health savings accounts, Jill already touched on these briefly, but I love health savings accounts just because you get a triple tax benefit. You get a deduction. They're not taxable when you use the money for medical expenses, and the growth is deferred as well. And so I would even favor maxing out a health savings account before other traditional retirement contributions because of that triple tax benefit. And additionally, once you reach age 65, you can effectively, your HSA becomes an IRA. You can use it for non-medical expenses, and it will be subject to tax, but you have that option. So it's like another IRA that you can be funding as well. You've already maxed out all your other methods or your other retirement contribution accounts. So for families, you have 7,200, individual 3,600. I think the amount bumps up by $50 for the individual and $100 for a family for 2022. One important note to make is once you apply for, you can't contribute to an HSA when you're on Medicare. And so just be aware, once you apply for Social Security, that makes you eligible for Medicare Type A. And so at that point, you wouldn't be able to contribute to an HSA. You can still use HSA money for medical expenses, you just can't make more contributions.
Hey, McKay, one note, I missed this when we were reviewing our slides, but the extra age, the age for an extra $1,000 into your health savings account is actually 55.
Oh, sorry about that.
It's different than
Different than
the
the IRA.
retirement. It's actually 55 for the extra $1,000 into a health savings account.
Perfect, thank you for pointing that out, Doug. And then also with the money inside of your HSA, typically you can invest that. Different HSA providers have different limits. Health Equity is a common one in Utah and in the nation really. And I think they have like a $2,000 limit, and once you exceed $2,000, you can start investing it. Which would be nice if my kids didn't give me so many medical expenses. Seems like the money goes in and it comes right back out. So flexible savings accounts, I don't see those as much, but they're fairly similar to an HSA. You don't have to be in a high deductible health plan to qualify for a flexible savings account. You don't have the added benefit of, well, with an FSA, flexible savings account, the money is not really yours, it's your employer's. And so that money doesn't roll over from year to year, except I think they allow $550. And if you leave employment, that money is forfeited and goes back to the employer. But there's still a time and a place to use those, and it can be a good advantage. So now talking more about actual investments, not specifically retirement accounts. So if you have a taxable brokerage account, you'll want to make sure if it makes sense to, I mean, I wouldn't make all decisions based on taxes, but if you can choose to make smart tax decisions as well as smart investment decisions, try to hold your investments for more than 12 months, because at that point they'll qualify for the long-term capital gain rates, which are lower. And so it's definitely in your favor if it makes sense to hold those investments for more than a year before selling. So you have some underperforming investments. You can do what's called tax loss harvesting. So say you invested, like my wife's family, for example, was heavily invested in General Electric, and which had been a great stock for many, many years, but it tanked fairly recently, you know, within the past couple of decades. It hadn't been performing as well. And so say you have a similar situation where you have a position that's dropped in value quite a bit, you can sell that security and buy a similar security. That way you're not out of the market in case it goes back up, and you're able to realize a loss on your tax return for selling that investment at a loss. Important to note, you have to wait at least 30 days before you buy that security again. Otherwise, it's called a wash sale, and you don't get to take that loss in your tax return. So that's a good thing to look for as well. This year, there's probably not as many underperforming stocks since the market's done well, but that's something to review periodically. Again, great opportunity to donate appreciated securities if you make charitable contributions, rather than selling an investment and donating the cash. That wouldn't be as smart because you'd have to pick up the gain, and then you would still get a charitable deduction, but it would make more sense to just donate that appreciated stock or other security, and you can get the charitable deduction you get is the fair market value of that security you donated, not your basis. And so that's a great opportunity. Municipal bonds typically make most sense for individuals in the higher income tax brackets, just because you may be able to get another investment that has a higher after-tax yield anyway. But if you're in the higher tax brackets, municipal bond interest is exempt from federal tax. And also if you, it is exempt from state income tax if you own a state municipal bond. Utah, for example, has reciprocity with a handful of other states, meaning it's an agreement not to tax that state's bonds. And so you'll want to, that's an option as well, municipal bonds. If you are interested in looking at that, what you'd need to compare is if the bond was yielding 4%, you would divide that 4% municipal bond yield by 1 minus your tax rate. So if it was 1 minus 37.37, if you're in the highest tax bracket, that ratio would be what you would compare to another, like a corporate bond, for example. And if the corporate bond was paying a higher yield than that ratio, then it would make sense to buy the corporate bond. 529 plans. A lot of states have 529 plans set up to help save for college. You get a small state tax credit, but it's nothing really to, it's not going to move the dial a whole lot, but you can get good tax deferral of your growth inside the 529. And qualified charitable distributions are a great option. Important to note, age 72 is now the age at which you have to take a required minimum distribution, but you can still do a qualified charitable distribution at age 70 and a half. So that age didn't jump up to 72. The RMD age used to be 70 and a half, so that's a little bit confusing. But how that works is rather than taking a distribution from your IRA, you can have you can satisfy like your required minimum distribution, for example, by donating directly from your IRA to the charity. That way you don't have to pick up that distribution as income and it still satisfies your required minimum distribution requirement. So that's a great option. Yeah, go ahead, question.
What if you're under age 70 and you have inherited IRA?
That's a good question, but you still would have to wait until age 70 and a half before you're able to do that. And the limit is 100,000 per individual. So married couple, you could do $200,000.
But that has to be from separate accounts.
IRAs. Yep, exactly.
An account in the husband's name and an account in
Exactly.
the spouse's name.
Yep. And that limit, the $100,000 limit is the same for 2022 as well. So that's a great option. A lot of people in Utah make annual charitable donations. If you're over 70 and a half, highly recommend that you look into doing your qualified charitable distribution. If you're going to be making charitable donations as well, you might as well keep that outside of your income, taxable income. Granted, you would still get a deduction if you took the cash distribution and then donated it, but it'd be better just to not include it as income in the first place and do a QCD. It could also help keep your amount of Social Security subject to tax lower, as well as potentially your Medicare premiums, since those are based on your income as well. So things to look at. And then just one last note, with the Build Back Better Act, Roth conversions for high income earners, so over 400,000 in income, would be, so they would shut that back door, and you wouldn't be able to do those conversions. So if you make backdoor Roth contributions, you might want to get in one last one in 2021 in case that door closes. But again, that's for individuals who have income over 400,000. And then, but again, that's no guarantee if it doesn't pass. And then RMDs. So if your total IRA account balance is over 10 million, you have an additional RMD requirement to take 50% of the amount in excess of $10 million. And if you have a Roth IRA with 20 million, you would have to start taking RMDs on the Roth IRA as well, which typically you wouldn't otherwise have to take a Roth IRA RMD. And so that money's still not taxable, but it gets it out of that money out of the tax. It's no longer sheltered from that tax deferred growth. And so any further income generated by those dollars would at that point be subject to tax. But that's all I had on the investment side. I'll turn it over to Doug.
Okay. So I wanted to talk about, first of all, just the long-term dividend or long-term capital gain and qualified dividend rates. So now these used to be simple. They've become quite a lot, or the figuring the rate that applies to $1 of capital gains is a lot more complicated now because number one, for the last several years, it's been integrated with ordinary income. So for example, if all income if all of your income combined together leaves you with taxable income after itemized deductions less than 80,800, you pay 0% on your long-term capital gain and qualified dividends. Short-term capital gain is going to be at your regular ordinary income rate. Then the same thing there, above 80,800, you start paying 15% tax on any capital gains that you have. And that's after paying the ordinary rate, which Jill covered on your ordinary income. And then once your income is over 501,600, you'll pay 20% in capital gains tax. And then, so the other big factor that's been around for quite a few years now is the net investment income tax. That's going to add 3.8% tax on your modified adjusted gross income over 250,000. And notice the taxable income above is not the same as the modified adjusted gross income. The modified adjusted gross income is before itemized deductions. So that's one of the things that factor there. You can make some pretty good estimates on what your long-term capital gains tax rate is, but you have to know, you usually have to estimate and you don't know for sure until everything is said and done and is factored in there. Now, one other thing to point out, well, just as a summary there, the top federal capital gains rate that we generally apply is the 20% for somebody in high income plus the 3.8. So 23.8 is usually the top federal long-term capital gains rate. For Utah, we would add 4.95% in state tax rates, but so it's in there. Now, the net investment income tax we've been dealing with for several years now. I think that started in 2010 or 2012. We've kind of learned what income is subject to that and what income is not subject to that net investment income tax. Usually, if it's pass-through income from a company in which you materially participate, you can avoid that net investment income tax. One of the proposals in the Build Back Better Act right now may change that for people in higher income brackets. So that they may make all pass-through income, anything that comes from a trade or business, add that to what would be subject to net investment income tax, along with the capital gains, ordinary income, and the dividend rates there. I wanted to also point out, even though it's a different, so that one of the proposed tax rate is the surtax on high income earners. It really doesn't fit on this page very well, but I wanted to mention that. That would add 5%. A 5% tax rate on individuals with income of greater than $10 million. And then for a person with income in excess of $25 million, it would add an extra 3% on that. So potentially a top 8%. That I believe is the main source of funding that they're looking at right now to go with the Build Back Better Act. Now, this is the version that was passed by the House of Representatives back in October, at the end of October. Right now, the Senate's, they're back from their Thanksgiving recess. The Senate's picking that up. We'll probably start seeing news coming out about that now as to where that's going. But meanwhile, we're just kind of watching there to see what happens. So what I'm looking at here is business investment and planning strategies. The idea we're coming from here is if you're an individual owner in a business, what strategies are available to help you control your tax there and limit your tax there. So I want to go through several of those. So a real estate 1031 exchange, this has been around for my whole career. It's a pretty powerful thing. If you need to sell one piece of real estate, but you want to stay invested in real estate, you can take the proceeds of that, set up a qualified escrow account prior to your sale, put it into your new real estate and not pay any tax on that. One of the campaign proposals on Build Back Better, or some of the discussion points early on, was that would be limited and unavailable to anybody with income over $400,000. As of right now, that's not in the current version of the act. So it's there. So it's still something to use. It's something to plan on. If you're in a situation where you want to stay invested in real estate, it's hard to beat a 1031 exchange. Basis step up at death. This is one thing that happens quite all the time anyway, because people, I don't think we've figured out a way around death. So we all plan on that at some point. And that's one of the tax planning things. If you're inheriting property from from your parents or somebody who's passed away, you get that basis step up. So whatever the value is at the time of death is what its basis is. So if you sell it shortly after that death, you may have little or no gain on that. If you hold it for several years, then you'd measure that gain that you would pay tax on from the value as of the time of death from that basis step up. Some of the proposals that propose doing away with that as well. That is not in the latest act. The removal of the basis step up has actually been put into play and talked about a few times over the last several years. Actually, for the year 2010, when there was the one opportunity to elect out of the estate tax, that was the year George Steinbrenner died, and who was the other? Well, there was one other wealthy guy who died then, but they famously died in 2010. They could elect out of the estate tax in that year, but if you elected out, you didn't get your basis step up. So that was kind of a pick and choose. That's disappeared since then. That's the only year in my career that choice has ever been there. We'll kind of see what happens otherwise there. Another thing to plan for on a business sale is rolling over any non-cash proceeds that you receive. So if you own a business, you're going to sell 49% of it, keep 51% of it. It's really very heavily in your interest to structure that 51% you're keeping, or whatever percentage you're keeping, as something that's non-taxable, because you may have zero basis in that business. It may be worth $10 million. The portion you're keeping may be worth $10 million. So you want to avoid the tax on that if you can. And there are structures where you can do that in many situations. If the business is organized as a partnership, an LLC or a partnership, you can use there's a code section 721 that lets you create a new partnership with your new owners by dropping the investment down into that and avoid taxing on that. If you need to incorporate or put your business into a corporate structure, section 351 in some cases can allow you to avoid tax on the non-cash portion of that. Now there's an 80% limit, 80% ownership limit on the corporate stock, which makes that a little bit more of a limiting factor than the partnership interest, but there's quite a few things that you can do with that. Qualified small business stock is a pretty powerful exclusion as well. That's the 1202 stock exclusion. This is for it's a C corporation investor, somebody who's invested in a C corporation. It has to be a C corporation, and they have to have been the most powerful. There's actually been a few different versions of this over the last 20 years or so. For anything under the law right now, for anything was invested after a date in 2010 and has been held for 5 years, when the individual shareholder sells that stock, he can exclude up to $10 million of gain on the sale of that stock and not have that included in income. Now, for qualified small business stock, small is defined as a company issuing stock at a time when its total capital is less than $50 million. So you can do quite a lot and still call it a small business, and that happens pretty frequently with a lot of companies. Now that only works with a C corporation. It does not work with an LLC taxed as a partnership or with an S corporation. That is one of the big incentives right now for people to set up C corporations. So, but that becomes a pretty powerful thing. Now, one thing to keep in mind is that the current version of the Build Back Better Act would roll back the 100% exclusion that's been available for investments since 2010. It'll also roll back the 75% exclusion that was available for some prior investment, and it would leave the 1202 exclusion at 50%. So you'd still have to pay tax on half of your capital gain on the sale of that. We're watching that right now. We've got clients who had converted to a C corporation for a lot of business reasons, but one of those was to potentially take advantage of the qualified small business stock exclusion, that are having to plan, what do we do if this goes away? Now, you still want to do the best you can with business-wise as opposed to tax-wise, as McKay kind of mentioned there. Make a good economic decision as opposed to a tax decision, but that might be a tax benefit that would go away there. Qualified Opportunity Zone investment. This is something that's been available since the 2018 Tax Act. this is really one of the most flexible and pretty powerful ways to defer tax on capital gain income. With qualified opportunity zone, if you sell stock, you incur a capital gain, then you can decide to invest in a qualified opportunity zone fund anytime within 180 days after you incur that gain, and you can shelter that gain by putting the gain amount into a qualified opportunity fund. Now, it's pretty powerful. You have to, just like any investment, you have to understand the economics of the investment and be happy with those on the way there. And you have to make sure the price you're buying at is something that will allow you to get a sell there. But it can be a very powerful thing there. And then another thing which for avoiding or deferring income is just the general acceleration of business deductions. This can apply in regular everyday operation of the business. If you're acquiring a piece of real estate, for example, you can have a cost segregation study done on that, and then take accelerated depreciation on the non-structurable portion of the building that you're buying. And that can be kind of a fairly powerful thing on a real estate, on a purchase of real estate. And there again, research and experimental expense deduction. This is actually pretty broad, where it covers a lot of software development costs, a lot of development costs on intellectual property of a lot of different types as well. So any wages, any normal operating expenses that go into development of that type of property are generally deductible as they go through. So that's again, it can be done on an operating basis, but it's also something you can look at on investing into a business. There are a lot of strategies you can do where you change the character and also the rate on the type of income that you have. So capital gains, as we've talked about, has generally, at least long-term capital gains, has a lower tax rate than that applies to ordinary income. So with long-term capital gains, short-term capital gains, not so much. It's going to have the same rate as the ordinary income. But long-term capital gains has that rate. So anytime you can structure in your sale to have capital gain, but by identifying the asset being purchased, sometimes you can choose whether you're selling an asset such as your ownership of a piece of equipment, or you could or a piece of real estate, or you could actually sell your interest in the LLC or the corporation that owns that real estate or piece of equipment. So there's different ways you can structure that and get capital gain versus ordinary income. The choice of entity, I mentioned before that one of the big drivers for people electing C corporations is that qualified small business stock gain exclusion. So there's the choice of S corporation, partnership, which is usually an LLC tax as a partnership, or C corporation. There's a lot of factors that go into that, but that can make a difference on what taxes you pay during the operation of the business and at the time of the sale of the business. So with a C corporation, one of the cautions is the double tax. You'd have the corporation paying tax at its normal rate, which is currently 21% for corporations. But then you'd also potentially, if you're taking income earned by that corporation and paying it out as a dividend, you'd also potentially have the shareholder paying tax at 23.8% on that same income. So that's the double tax that can apply with the C corporation. There are some strategies where you can look at that and try to avoid that or minimize that. Qualified small business stock there as well. So the change of character went from in this case, it would be going from fully taxable capital gain to the rate reduction would make it, under the current law right now, up to $10 million of income for an individual could be taxed at 0% federal, which now Utah actually also allows that exclusion. It's an exclusion from income, so it helps Utah would avoid the gain on that as well. So it's a pretty powerful thing. We'll have to see what happens if that act goes through. And then qualified business income for pass-through entity ordinary income. This is something that's been around since 2018. We've been working with that for quite a few years. That's where you can take 20% of your income that qualifies as qualified business income and subtract 20% of that, so you're effectively only taxed on 80% of it. That can reduce your 37% top tax rate on ordinary income down to 29.6 by just taking off 20% of it. And it's something that's pretty powerful. It's been around for a long time, and a lot of businesses have learned how to use that and have had a lot of success there. And then shifting income. There are strategies to do that validly. Now, it cannot be arbitrary. You've got to have business reasons and valid changes of ownership as well. So a partnership profits interest to key employees, that's a pretty powerful way there. This could be mentioned at the same time as, it is kind of in the same way as issuing stock options in a corporation to employees, to key employees there. A partnership profits interest is actually even a little more powerful than that, though. You have to be giving, what you're doing is giving to your key employees a certain percentage of the future growth of the company. It doesn't include, it cannot include any value in the company at the current time if you're giving them a profits interest. But if all you're giving to your key employee is a percentage of the future growth of the company above the threshold at which it's at now, that grant of ownership is not taxable to the employee as of right now. Any income generated in the future might generate tax on a K-1 to that employee, but that grant is not there now. So as I mentioned, that is usually considered in a partnership structure in a similar way to which stock options would be considered in a corporate structure. You can shift income by bonuses to key employees. Oftentimes in a business sale, the owners determine, and sometimes this is based on agreements with employees that have been made as they've been hired or as they've come along. You can have an agreement that out of the proceeds of the sale, we have this owner group here, we have this key employee group. A lot of times there's crossover between the two, but you can have the owner group deciding that this key employee group has contributed to the success of the business, so we're gonna set aside tens of thousands or hundreds of thousands of dollars for those employees to benefit from this sale of the business. That becomes a deduction to the business, or if it's passed through business, to the owners of the business. You can also gift ownership. Now, 20 or 25 years ago, having family partnerships was very common. There was a big tax incentive for parents to maybe shift some of their investment income, maybe real estate income, maybe stock income to their kids. In more recent years, probably for the last 10 or 15 years, most of the tax incentives to do that have disappeared. There still may be estate planning benefits, but more often you see estate planning use different types of entities, intentionally defective grantor trusts, for example, rather than family partnerships that do that. But if you gift ownership to somebody and then sell the business, then the gain associated with the ownership that's owned by somebody else, whether it's my partner, whether it's my kids or anybody else, is going to be excluded from my income, for example. Now, a lot of these strategies are going to need advanced planning in order to be able to implement correctly. So you have to be pretty careful with that. Some of them can be done at the last minute, but a lot of those can be done there. So just with a little foresight on the sale of the business, there's quite a few things that you can do there. So I don't think I have it. Yeah, that's my slide. So open it up for questions. Sarah, if you don't have any questions asked, you have to ask them, right?
I could think of a million questions.
Oh, there you go.
We don't have time for all my questions,
Okay,
but we can give it a minute and see.
sure.
Cause I don't think it tells me when somebody's typing, but.
Let me ask you one question. On a step up of in basis on a piece of property, does it depend on how the property is held in order to qualify for that?
Yes, it does. So if you own the real estate, if it's in your name, the real estate's in your own name, then you'll get the basis step up on that. Well, if you pass away owning it, I should say, or through your revocable trust or with a power of appointment trust or something like that, then you would get that. If you own it in an LLC that's taxed as a partnership, then your basis step up is going to apply to your ownership in the of the interest in your partnership. Say you own 50% of a LLC, then your 50% would get its basis step up to its fair market value, which is going to be tied to the value of the real estate. But then in the LLC, the partnership can elect to make a 754 election, and then because of your death, it can actually step up the basis of the partner property, the real estate in there, as it applies to the heirs of your 50% ownership. Now, if it's in a C corporation, the basis step up applies only to your stock and not to the real estate in the corporation. Same rule with an S corporation. Your stock does a basis step up, but the real estate in the corporation does not. So how you own that's the choice of entity structure there, and that becomes pretty important there. Good question. Thanks. We had a drive there. We needed a question. So.
We do see sometimes people gifting like a house or something like that to their children in their lifetime, which again, we wouldn't recommend because then they miss out on that basis step up at death. So
Right.
it's better to wait and have them actually inherit it. Yeah.
And obviously that depends on whether the person's going to pay estate tax or not. But, you know, with the $24 million for a married couple, a $24 million combined lifetime exclusion, most people, I mean, the substantial majority are not going to pay estate tax. And so they're more focused on maximizing the basis step up for their heirs. I guess. Now there are some strategies you can do. If you've got real estate owned in a corporation, there are some strategies you can do. One of those, if you're in a C corporation, it may not matter that much. Actually, even then it does though. You kind of decide when you can take the loss, close the corporation down, liquidate it, take your loss. But the same thing applies in an S corporation. If you're going to sell that, the S corporation is going to sell that real estate, it will trigger a gain that it passes out to you. What you want to do as a shareholder is to dissolve the corporation in the same year, and then you're going to have a residual loss that you can take on the liquidation of your stock. So there's ways you can have the pass-through income on your or pass-through gain on your K1, but then a loss on liquidation on your stock. So there's strategies you can do, but you just have to plan ahead depending on what the circumstances are. Guess we have a few minutes, just a minute for other questions. If there's no other questions, then we can go back to Whitney.
All right, thanks everybody for joining us. I will be sure to send out the recording of this presentation and the slides to all the attendees that have registered. And yeah, reach out if you have any questions.
Thanks, everyone. Thanks for attending.